All right. You're up, Evan. What do we
All
got?
right. Yeah, what's going on, guys? Welcome back to a little Q&A. The first question I've got for you here was so about buying a house, actually. So the message was my wife and I were blessed to be able to buy a house, and he faintly remembers what you said about paying weekly instead of monthly on the mortgage, and how that could cut off 5 to 7 years of your mortgage payments. Could you explain that process again?
Yes, let me share my screen. Okay. All right, can you see my screen?
Yep.
All right, so I'm going to send this calculator also in this chat here. And I would keep this saved like in your bookmarks if buying a home is somewhere in your future. This number in particular, they had, I spoke to them last week, it was a $350,000 house. Their interest rate was 5.5. It was a 30-year mortgage. They just got the home, so they had no payments made. And here is the extra amount. Now, before I get into this, I kind of had like a realization with this process. And the hardest part for most people with making this change is that everyone is so used to paying monthly. That we're going to say your mortgage is $2,000 a month. Most people are very locked into paying $2,000 a month. When $500 a week is the same amount of money, but for whatever reason, it really like jams people up. And I've done these exact scenarios with other individuals. This person I spoke last week, he set this up, but I know a lot of times that hesitation of making the change. And the one realization I kind of came to after having a lot of these conversations was the same principles of the weekly payments and biweekly will do the same thing to your mortgage if you were just to increase the monthly minimum. So if your monthly minimum is $2,000 and you slowly start to increase it to $2,200, you're going to make an extra principal payment throughout the year. And that's the same thing that what switching to weekly does. So if you for example, if you have, again, you can't really see my calculator, and I'm going to go more into this part, but I want to just briefly explain kind of the bigger picture of this philosophy that, again, it can lose a lot of people. But if we stick on this same $2,000 a month example, so you have $2,000 a month times 12 months, that's $24,000 in payments. Now, if we do that same $500 a week, and that's times 52 weeks, it's $26,000. So the monthly, you pay $24,000, same monthly amount. Weekly, you kind of sneak in an extra $2,000 a year in payments that you don't really feel, but that's where the numbers, that's where those numbers kind of add up. That's even though it's the same amount of money monthly, it's those extra few weeks of payments that kind of get snuck in because it's just more frequent. And that's why when you see here, when I calculate this, so we did a $350,000 mortgage, 5.5% interest rate, 30-year mortgage, no payments made, no extra amount. And we see here, it's like this $500 a week example. Again, it's not factoring in your taxes, things like that. So this is just basically your the loan amount and the interest rate. That's all this calculator is going to factor. So if that's why these numbers may be a little bit different for the loan person. But when you see here, when you compare it, monthly, you're paying $2,000, takes 360 months to pay it off. You pay $365,000 in interest. So you had a $350,000 home. After 30 years, your all-in expense is about $700,000 before we factor in taxes. By switching to biweekly, you end up making an additional principal payment throughout the year, and it knocks off 60 months worth of payment. 5 years off your mortgage gets cut off by making that change from $2,000 a month to $1,000 every 2 weeks. Mm-hmm. And then you only end up paying $300,000 in interest versus the $360,000. And then if we go that one step further and we go down to weekly, you pay it off in 250 months, which is almost 10 years, a little less than 10 years faster. You only pay $245,000 in interest, and you save about $120,000. And if you see it here on this breakdown, like this yearly breakdown, this is doing it the regular way. Like 99% of people, this first column, they take them 30 years to pay it off. the 1% of people who do biweekly and weekly, you can see here biweekly, we get down to 24 months, 24 years, and then for weekly down to 21, so like 9 years off. Now, that's just this one simple change. Hey, you're blue barking.
No, not at all.
Yeah. So that now this is simply just making the same monthly amount in smaller increments more consistently. Most mortgage lenders, Wells Fargo is one of the biggest mortgage lenders who buys mortgages like from the private markets. So if you have like some random, give me a second, let me go.
Yeah, guys, mortgages. So basically, pay more frequently. Kind of just breaks down the thing without, at the end of the year, you end up putting more towards the mortgage, but throughout the year and throughout the months and the weeks, you don't feel it the same way that you would if you just decided to add that extra 10% at the end of your last month, which is sort of the whole point. Hey, welcome back.
I brought him back so he's not barking at the dogs walking by. But yeah, so
the dog is still barking.
But yeah, so this is simply just changing. I was mentioning before about Wells Fargo. They offer weekly options. You have to basically just call them and just say you want to set it up. It's one phone call to save yourself, in this example, $120,000. So it's the most expensive phone call or cost-saving phone call you will probably ever make in your entire life. There's no other thing I could think of that a 5-minute phone call could save you $100,000. So that's not paying anything extra. This is strictly just switching the frequency. And if the lender says, no, we won't do biweekly, we won't do weekly, then you can just increase the monthly minimum and it will also do the same thing. So that's my bigger point is I know a lot of people don't want to pay weekly, or making that phone call scares them. I don't know, but I've definitely I've felt resistance on this topic where just making the additional principal payment will do the same thing. And this is where now, if we're going to say, okay, the mortgage is $2,000 and we're going to pay an extra $200 a month, we're going to pay $2,200 on this calculator, that's $50 extra a week. Doing that extra $200 a month before we saved about $120,000 by not paying anything extra. By paying that extra $200 a month, that's an additional $40,000 saving that you're going to personally benefit from. And before, it was the weekly example ended at 21 years. Now you're at 18 years. So this is more just like how we have for the guys that are in the longer term group, where we have the goal of increasing the weekly contributions to our long-term accounts by insignificant increases each week, $1, $2, $5. You can follow the same principle and approach with your mortgage, and it will have the same effect. So, you can start with an extra $50 a month, then an extra $60, and then $70. And eventually now, if we up this to say $200, it's an extra, this in this example, we're going to say extra $250. This person's mortgage was $2,000 a month. Maybe it's 5 years from now, and now they're paying $3,000 a month. And in this example, now they're down to 11 years. You can see here, this is 11 years. They own the home outright. They've saved $241,000 in interest. So that means that the average individual who pays the minimum, does not care about weekly or biweekly, does not increase the principal payments, buys a $350,000 home, takes them 30 years, and it costs them $700,000 to own that home in 30 years. The person who follows this approach by switches to weekly, works on increasing the weekly or monthly minimums, and for this individual who's paying now $1,000 more than the minimum, instead of $2,000, they're paying $3,000. They end up saving $241,000, where this $350,000 home cost them $475,000, and in a decade they're done. They're done with those $3,000 payments, and when they're done, that $3,000 payment can go anywhere else. It can go to the market. It can go to whatever you want to do. So the biggest thing, if you have a mortgage, I can do this scenario with you one-on-one and show you the biggest savings. Again, making that phone call and switching from monthly to biweekly and or weekly will be the most beneficial thing you can ever do for yourself financially in such a small amount of time. There's nothing that I can think of humanly possible where you can save 100 grand in one phone call. And then getting in that habit of increasing those weekly, biweekly, or monthly payments very insignificantly over time will have, dramatic effects. And this is something I even saw personally with, the home I'm in at the moment. Go stop barking, buddy, come on. Before I refinanced, when I finished the house, I paid off almost 12% of the mortgage in 2 years, which if I paid the regular way, I would have paid like 3 or 4% off, because the front of the mortgage is often just very interest heavy, where you're not really making big principal payments. But since I was making weekly payments, I was paying like an extra, I think it was like $400 or $500 a month, so an extra $100 a week. I was just chipping. Even when I refunded the mortgage guy, I was like, damn, I can't believe you paid this much off. And this is my own personal, like, I saw the benefits of it in real time, other than just this calculator, spitting out these numbers. So this is one of the biggest things that I think, if you have a mortgage and you're not doing this, you're at an extreme disadvantage.
Yeah. Okay, great. And actually, kind of adding on to this is like, because like for me personally, I don't own a home, I rent for now. And I'm sort of trying to figure out like, when does it become more beneficial to own get a mortgage and own a property versus renting an apartment or a house? If you have any advice on that, Ben.
Well, so it's tricky for you because you're in Miami, and Miami price, like just Miami itself is just, it's a very wealthy area. It's not like
I'm not buying a house for 350 grand here.
Yeah, that's like
350 grand.
You could buy like a porta potty for that in Miami. But
maybe
I think the biggest thing with most people, and even for like your mortgage, like your rent is the equivalent of this person's $350,000 home. And you probably could find an apartment, maybe it's like a studio, maybe not in downtown Miami, maybe 10 minutes out, where you can find something at that similar price point. I think the biggest hurdle for most people and why they avoid buying a home and stick with renting is the down payment. I think that's often the biggest factor that keeps someone out. So for this $350,000 home, if this person put 20% down, that's $70,000. That's usually the barrier of entry for most people, but you don't have to put 20% down. And a big thing for myself that I was always very against for many years was FHA lending, where you can put 3.5% or 5% down. And I was always so against it because you had to pay what's called PMI, private mortgage insurance. And it's basically saying the mortgage company wants an extra layer of insurance on your loan because you don't have that much skin in the game. It's like it's like you buying one call option versus me buying 100 shares of Amazon. Like, I have much more skin in the game than that call.
Yeah.
And I was very against the PMI because in my thought, this was $200 a month, $300 a month that was purely wasted because I didn't want to put money down, or this person didn't want to put money down. But one of the things that I eventually learned, because I have spears in real estate, and I have a bunch of friends who are mortgage lenders, and I've kind of chewed the ear on this topic. And one of the things that I wasn't aware of was when you have this PMI, this extra insurance, which you have to have if you don't have a conventional loan, if you put 3.5 or 5% down, is that you'll often get a better rate because the mortgage lender knows even if you mess up, this insurance is going to cover the loan. So you might seem risky to the buyer. Like if you were coming to buy my house and it's Heaven who wants to put 3% down on my home and Tom who wants to put 25% down, me as the seller, me as the owner of the home, I'm going to go with Tom's offer because he's a more credible buyer. But on the mortgage standpoint, they don't care. They want to get you approved. They want to give you the money, and they want to make that $300,000 in interest earned over 30 years. Mm-hmm. So that was one thing that I kind of became more aware of, where if you would have asked me this question 2 years ago, I'd have been like, oh, people who go FHA are stupid, or it's whatever. Now, knowing that you can almost get a little bit of a better rate. And if in this example, he's at 5.5%, maybe he could have gotten down to 5% with FHA lending, meaning he would have put less money down. He might have gotten a better rate. And that 0.5% difference on that loan might have been a $300 a month savings on the interest anyways, where it was kind of a wash, where you might see the line item on his bill of PMI insurance for whatever, $250, but he might have actually saved money. And that was something that, again, I've come to be more understanding of. And that's something where, first time home buyers, they can do FHA lending. And it might be harder for you to get the home because you won't be as credible to the seller of the home. But it's not like this is the dream home. It's the first home and, or first apartment or whatever it is. So I think the biggest thing is the down payment, and knowing that you can put, 3 to 5% down makes it much more realistic. 5% down on 350 is I think like $14,000, something like that.
Yeah. Well, 10% is 35.
Yeah, so 12 to 15,000. So that becomes so now it becomes, okay, before maybe I thought I needed $70,000 to put down, but now
18,
20. And then it's okay. I have this lease for another year. It's going to expire. I have a year to come up with 20 grand or 20K to earmark for my trading account. And then
no, don't do that.
And then like 6 months out, you start looking for the apartment, and then you can kind of line everything up. But yeah, hopefully.
Okay, cool. Well, that's good to know. Yeah. We got one more question that actually I was doing a lesson review with David in step 5, and his question was he's completely different side of things, but he was just kind of like thinking about alpha chat, where he's like, I'm working through these 10 steps, I'm learning all these things to sort of get to the alpha chat. And he kind of just blatantly asked, like, so what am I getting to exactly? Like, what is alpha chat? Like, why do I want to be in this chat? So Ben, if you'd like to maybe talk about that.
Yeah. So again, we make it very difficult to get into alpha chat. Again, he's halfway through. He's read at least 600 pages worth of our lessons at this point. He's got another 400 to 500 to go. So we make the barrier of entry difficult for a reason. Because once you do the work to get there, you can't really fake all the work. You may be able to get past a lesson without Heaven catching it or me catching it, but for the most part, you have to do the work to get into that group. And by doing that, it keeps everyone in that group who's all done that work to get there on point. Where years ago, when it was maybe 3 steps, you could get through the 3 steps pretty easily. You can get in the group, and maybe you can joke around, you can kid and bullshit. But now when it's this much more difficult, it's very hard for someone to want to mess around and then goof off getting into alpha chat. Not saying we're very serious, but everyone there is there to make money and find the best opportunities. And by making the process very difficult, it weeds out the people who really aren't interested in scanning the market every day to find setups or finding these game plans or vocalizing them in the chat. So there's reasons why we make it difficult. And also we want you to come into the market and be prepared where you can put on trades without really having to be handheld the entire time. Where by going through these lessons, we're kind of building up your trading foundation that when that time comes and you will be ready to trade, you should be ready by the time you get to the alpha chat. And there will be a whole new basket of lessons that you will learn almost every daily from each trade you put on. But we can avoid a lot of the lessons that could have been avoided without having a loss attached to it. And there was a member who is not on this call who has been on the last few of them with very detailed questions he's always had. And he was a perfect example of this, where he started to trade before getting through the program, and he was making mistakes that were in the lessons. And it's like, okay, you lost $200 here. You could have read this lesson for free. You lost $100 here. Again, you could have read the lesson. So it's like, here's $600 worth of losses that this person had that could have been avoided had they just focused on the education side. And then when they were in that situation, they would have known, okay, the stock is gapping down under my stop. What I should be doing is waiting 15 minutes, let that candle close, put my stop below that low. If it's close to the figure, if it's gapping down to 50.25, I'm not going to put the stop under that. I'm going to go on 49.89. I'll give it the extra couple of cents. And then the stock reverses, and it wasn't a profitable trade, but he could have gone out break even. And that was one of those things where that's a 15-minute rule. That's a lesson in the handbook, and that you could have avoided by doing it the way that we've set it up, where we're trying to set this process up that you can avoid any unnecessary losses for these few months. And there will be losses when you start to trade, but we can avoid the unnecessary ones by just following what we've set up over the past couple of years.
Yeah. And I mean, especially right now, I talked to a bunch of our members that are in the lower chats, and they're very eager to start trading. They're like, when can I start trading? When can I start trading? I'm like, I mean, you could start today, but like, I mean, even if you went through all the lessons, you probably don't even want to be trading right now. So it's like, there's no better time right now than to like be studying and really learning what we teach. There's plenty of methods to trade out there. We don't teach all of them. We're primarily swing traders, and this is not a great swing trading environment. So it's a perfect time to learn how to actually do it and execute so that you can really take advantage of when that market starts to turn around. You'll have some really great swings and you'll learn a lot like right in that beginning. So, focusing on the lessons, but it wasn't more so like, why am I doing this? Like, because also what I told him, I was like, you could get to alpha chat and then hate it and leave, but you learn the 10 steps, and that's kind of the goal, is to teach you how to trade on your own. It's not like you're not trying to get to alpha chat so that you could just copy what Shake is doing, which I think is kind of a stigma that a lot of people get, because there's a lot of trading groups out there that are run like that. It's just, I'm the boss, check out my signals, this is what I'm buying and selling right now, and follow this. And we're not that at all. We're there to get you to learn on your own and learn how to trade on your own, and then obviously have that insight from Shake and from you and from some great traders that we have in the chat, so they can share their ideas and experiences. But overall, it's more of just having access to a really good community of people that are, like you said, have gone through the training, so they kind of know what they're talking about. But people still in many different levels of their trading. Some people just got to alpha chat last week. Some people have been there for years. So it's always cool to get a mix of viewpoints and things like that. And he had also mentioned that he works from 9 to 5, so he's not really going to be an active trader. So he was sort of scared, like, am I working towards this chat that's not going to really do anything for me? And I kind of had him understand that, like, it's not like that at all, because like I said, you're learning those 10 steps, and then even if you're not active, I mean, how many people do we have in the chat? We have like 200, almost 300 members in alpha chat. It's not like 300 people are talking, banging the keys all day long, like trying to make these quick trades and stuff like that. Yes, we have some people that are active daily, but for the most part, people go to their full-time jobs. They go to school. Some of them are students, some of them do both. But they can look at the chat when they have some time, whether that's after hours or in the mornings, or watch our pre-market Monday videos, or watching the chart talks, and then focusing on those larger swing trades. You don't need to be in front of the screens. You don't need to quit your job and become like, okay, Blue, I'm sorry, bro. If you want to be a trader, Blue, you could be a trader. It's fine. Okay, just don't bark at me anymore. But yeah, man, it's working your way to that, and you don't really understand it until you get to it, kind of thing. It's like Fight Club. You don't talk about Fight Club. You just gotta work your way up there. And yeah, so David's almost there. He's in step 7 now. He cruised through step 6, and we'll get an alpha chat, and then maybe then he'll get a better understanding of what it's all about too, because you got to experience it as well.
I think that one other point, I was talking with an individual before, and they had a question about like the cost. And the question was, if I go through this challenge in 3 months after the free trial, will I start to be able to make back the monthly cost from my trading? And I was like, honestly, probably not. It'll probably take you at least a year to even get to that point. And if you break it in the first year, that's amazing. But I don't want to say it's a bad mindset, but it's a wrong way to look at things, where we talked about the mortgage before. So if this individual had a mortgage and we go through that lesson, and this, give me 1 second, let me let this blow.
Yeah. But I think I know what Ben is going to say here. And it's just that, and I've had people come to me as well. They're like, well, what's the return on investment here? Because if I'm spending X, Y, Z a month, I want to make sure that I'm making X, Y, Z a month as well at the end of it, and it's just like you said. Well, you can continue. Go ahead, Ben.
Yeah. So for this part, we did this example before for the mortgage. So like my big goal, especially when I do the financial plan with the members when they get to the 10th step, is to make sure that they have a mortgage, they switch to biweekly or weekly, or increase their monthly minimums. So that's $100,000 box that we can check. 99% of people that we do the 401k reviews with always have it set up incorrectly. This member that I was talking to before, who just signed up, she had it set up like completely backwards. So I was telling her, I'm like, look, this is all backwards. You're pre-tax, you're at 1% contributions in your target date fund. you will retire with 50 grand in 40 years if you stay at 1%. Like it's just not realistic. You'll be kind of fucked. But if we switch the pre-tax to Roth, we switch 1% to 3% for now, and then next month 4 and 5 on to 10. We get to the target date, we go into the SPY. Just that change alone, even if you signed up for a day, you did that 401k review with me, and then you left, you're not going to undo it. You're not going to go back and like screw your 401k potentially, because it'd be against your own best interest. But that alone is another $1 million conversation that person is going to be set up with for the rest of their life. So on my end, it's okay. Can we get the mortgage set up correctly? Can we get the 401k set up correctly? Can we get your long-term investment account set up where it's passive and automated? Can we make sure the Roth is set up properly? Can we also teach you how to swing trade? If we can do even 1 or 2 of those things, it's 100x return on even what you paid for the year. And if we combine all of those things, it's like 1,000-to-1. And these are all things that are not unrealistic to get done within this period, because a lot of these are very easy levers to pull. Mortgage is 1 phone call. M1 setup is a 15-minute Zoom call. 401k review, 10-minute phone call. Financial plan, an hour Zoom call. These are all things that are not, I have to sit in front of a computer from 9 a.m. till 4 p.m. to make $100 to make back the membership. It's the bigger things are the things that we can do once or twice and check yearly that will have the biggest impact. And that's like my bigger focus, not, and then of course, Shake's big focus is on the day-to-day opportunities. And that's the ones that we obviously want to teach you how to find on your own. But that's where, like, when I see it from like the cost standpoint, I look at it as, if I can get you to do one of these 5 things, it's the best risk reward trade possible. But most don't see it that way, because again, they have to go through it to get to some of those parts. But that's where I see the biggest part of the value. But I understand that most see it just as, this is a cost for the month, and how can I get that immediate return, where a lot of it isn't going to be immediate, but it will come over time.
And I can definitely relate to that. Like, even in the beginning for me, I was just like, well, I just want to make enough to pay the membership, which in the beginning I understood, like, I'm here to learn, so I don't mind paying for an education. That's not a problem. But then the goal, once I started finding some traction and making some trades, like, okay, well, now the goal is like, let's make how much I need to invest in my education every month. Let's make that much. And then, it started making a little bit more. And then over 2-3 years, your gains start to compound, your capital gets bigger, you're better with larger size. And now all of a sudden I'm making an entire year's worth of membership in like 2 hours of a good trade. So it's like, okay, yeah, I was quote unquote losing money for the first year investing in my education, but now I can make 10 times that in a week. So it's like, you have to look a little more than just what are you doing at the end of the month, and you have to look a little further than that. And like we say, even in trading, is you have to look at the big picture. So, it's like, you're not going to your college education board and you're like, I'm spending $40,000 on this. How am I going to make $40,000 by the end of the year on this? Because I spent $40,000. So I got to have 100% return on investment by the end of the month. So, it's zooming out, looking at the big picture is definitely a big key there. And that's all I got for this week.
All right, and I think we got some 2 good points this week. So I think we did. Yeah, hope you guys enjoyed listening to me and having chit chat while Blue yapped in the background. But
yeah, thanks for joining us, guys, and we will see you next week.
All right.
Peace.